All right. Well, hey, everyone. Welcome to another monthly market update, but this one's going to be quarterly. So like we've done for the past few months, Josh and I just kind of, instead of doing a combined one every month, which can be a little hectic to schedule, we're going to combine for the quarterly ones because that gives us a little bit more data to talk about and just give you a little bit bigger picture than maybe what's happening from one month to the next month. So real quick, our agenda is really simple. We're going to talk about mortgage rates. We're going to talk about the national real estate market, and we're going to talk about the local real estate market. And that shouldn't say March real estate stats. It should really say first quarter real estate stats, but we're going to go over March as well. So that is sort of the short and simple of what we want to do. Again, we're trying to keep these videos long enough, but not too long. So Josh, I'm going to go ahead and let you just kind of do what you usually do. Introduce yourself and say hi to everybody.
Hey guys, it's Josh Pruitt with Movement Mortgage here in the Tri-Cities, licensed in Tennessee, Virginia, and Kentucky. So if you ever need any help in those areas, I'm happy to help you. So let's jump into mortgage market update. So as you all know, this week has not been a great week for rates.
The headlines have been brutal.
Yeah, so if you look at the headlines, April 10th, 2024, mortgage rates hit highest level since November after hot inflation report. So definitely not what we want to see out in the market today. And there's been a lot of talks about rates coming down. When are they going to come down? What does all that look like? There's a lot of factors. We'll go over here in just a minute, but there's a lot of factors that go into the rates, based off the economy, based off of jobs, the jobs report. When we read this, you'll understand that the Feds don't have the full control over what happens with the rates as much as people think. So they play a big factor into it, but they are not the overall factor. So still trying to fight inflation, and we're still, jobs still have to be up, right, for rates to go down. So you see right now, average 30-year fixed mortgage rates. I've been seeing everything from, if you look at it on a 30-year conventional, I've seen everything around a 6.8 up to a 7.5. So, and that's been in this first quarter. A lot of factors that play into that is how good your credit is, how much money you're putting down, what your loan to value is. There's all kinds of factors that play into that. So, one of the things is, a lot of people don't understand is, if you have a really good credit, you put a lot of money down, sometimes you're going to get a better rate than what the national rate is. I've had that happen many a times. You look as of yesterday, 7.34% on a 30-year conventional. Here's the thing. We've been in this higher rate environment here for a good little while now. So, if you're planning on purchasing or buying, right now kind of is what it is. We've heard the talks of, date the rate, marry the house, and reality is, if you're looking for a home, don't be afraid to purchase right now. Yes, the rates are a little bit higher, may not qualify for what you want right now, but buy a home, get out of renting, live in it for 12 months or longer, refinance, or turn around and sell it and wait for the rates to come down and purchase, the home that you want. So,
And that's why I kind of snuck this graph in on you.
yeah,
This is showing the average 30-year fixed rates all the way back from 1971 to
yep,
till now. And I feel like all this talk about the high rates needs to be put in perspective because that red line is where the rate is at right now. And you can see that half of that graph was over that line and
yep,
the other half was under it. So it's not
yep,
like it's not like we're seeing something absolutely crazy happening right now.
right, right. Well, one of the trends, if you look at 2000, what happened in 2000? Remember Y2K?
Oh
There's a big
yeah.
scare the big scare that happened back in 2000. If you look since 2000, 2001, 2002, the rates really started to come down below that line at that point in time. Even look at 2008, the rates are kind of hanging around that top line of where we're at. But, rates are going to come down,
Mm-hmm.
period. They're going to come down. Are they going back down to two? No. They get down to 3, maybe over time, but they're going to come down. So,
Yes. The, the
so
the thing
bank
about that
rate
line
chief.
is everybody that said, well, I'm just going to wait. Rates came down in the beginning of the year, and everybody said, well, I want them to come down a little bit more before I purchased. Well, you're kind of losing out now because now you
Yeah,
lost out on that. It's like I try to tell everybody, if you try to time the market, it's not going to work out for you. You tried to time the rates, and now they're heading back up. So
yeah,
don't let the rates affect whether you buy or not. Obviously, they're going
right,
to affect how
right,
much you can purchase, but
right,
don't
a
wait to
hundred
purchase
percent,
based on what mortgage rates are.
100%. So we see here from Mr. Greg McBride, the bank rate chief financial analyst. It'll be difficult for mortgage rates to post a meaningful and sustained pullback from 7% until there's a greater consensus on what is next with inflation. And as I mentioned earlier, inflation is a big key in a lot of things. So this here, the Federal Reserve, talked about it earlier, influences mortgage rates but doesn't set them, right? At its March 2024 meeting, the central bank kept the federal funds rate unchanged and said it will keep an eye on economic developments to decide what is the next rate move will be. Mortgage rates are influenced by many elements, including the inflation rate, the pace of job creation, and whether the economy is growing or shrinking. I think that's a huge piece. The growing or shrinking in the economy is huge. The Federal Reserve's monetary policy is a factor too, and is set by the Federal Open Market Committee. So as you see, there's a lot of things that go into the rates. It's not just the Fed saying we're just going to do this. So
Yeah, and along with those rates, you talked to me about a product yesterday that I wanted you to bring up while we're
yeah,
here, and that was that FHA renovation loan. And the reason why I thought that was interesting
yeah,
is because, as anybody will tell you, if you've been out looking at homes right now, that sub 200,000 range, it's really hard to find a home that is not going to need some work. Um, and
absolutely.
I'll just put it, that's the best way I can phrase it. Which is
Yeah,
absolutely crazy to me because a decade ago when I started in real estate, the average sales price in the area was around 150. And now to think that
yeah,
150, there's a few of those at 150 that aren't really livable. Um, so,
yeah,
um, so you start getting below 200,000, it starts getting a little sketchy out there. Now that doesn't mean all of them, but they're more than you would want to see. So that's why I thought this was a great product, and I wanted you
absolutely.
to kind of explain it to everybody.
Yeah, just briefly, because there's a lot that comes with it. We have in-house renovation products for both purchasing and refinancing, but with FHA, conventional, USDA, and VA. And excuse me, the programs work the same. Typical FHA loan requires 3.5% down for a down payment. This product still applies the same even on a refinance, and of course, obviously, they'll take the equity in your home for that down payment and stuff, right? So, and for those repairs, but all the guidelines still stay the same when it comes to the renovation product. So, conventional, if you're first time home buyer, still could do with 3% down, or 5% down as the minimum. USDA 100%, VA 100%. There's no down payment requirements. And the same seller concessions apply for each one of those as well. So max seller concessions on FHA is 6%, USDA 6%, VA is 6% plus. I mean, there's really no limit on VA. And then, of course, conventional, depending on how much your down payment is or the percentage, you get anywhere from 3 to 6 to 9 to 12% towards closing costs. So with that, though, all the same things apply. There is no minimum, requirement on how much you're getting for the renovations outside of the limited 203K product, which is an FHA renovation loan. And some of them do have some maximums in there, but they're up there quite a bit. But the biggest thing is you have to qualify at the renovated rate, right, or renovated endpoint,
Mm-hmm.
right? So if you purchase at 150,000 and you put 50,000 into it, you got to qualify at 200,000. That's really the catch. Credit scores all still the same across the board. So it's a great product, especially in this market. If you are looking for a home that has a lot of potential, it's in the lower range, it's a great product to go with.
Yeah.
Um,
Well, especially,
because what's not going to happen is you're not going to buy it with an FHA loan with no
yeah.
repairs. So, and a renovation product gives you the repairs, right? Now, granted, you need to count on a 45 to 60-day window for a closing, for the everything to be completed. And let me just preface this, you cannot do the repairs yourself. So, has to have a licensed contractor. There's a process to it, but there has to be a licensed contractor to complete the work, give an estimate on supplies, work, what what all the costs and stuff is. It's all done on the front end, but all that has to be in place. So you cannot HGTV it yourself. Now, if you buy it with cash with Jay, and you got that money to do it, then you do whatever you want to. But if you're gonna go get a loan, you can't do it
Yeah.
yourself.
It just sounds like a good option for people to explore that are kind of buying their affordability ranges on the lower end of the market. I feel like it gives them an option to, if they find a house in an area that they really like, in a neighborhood that they really like, they kind of like the
Mm-hmm.
layout of the house and the yard, but there's some repair work that needs done. There's some renovating that needs to be done. This could be something that they could explore to see if it would work for them to help get that home, because the stats
Yeah.
always show that, especially, I just saw a statistic. It was something over the next 5 years. Don't quote me on this, but it was over the next 5 years. They expect the average homeowner to achieve another 80 something thousand dollars in home equity. Um,
Hmm.
so, if you're renting, you're not building up any equity. But if you purchase a
Right.
house now, odds are you're going to have some equity built up over the next 3 to 5 years. Nobody knows how much. So
Yep.
don't
Right.
take those numbers to heart. Nobody, you know, we'll show you the graphs. There's some times where appreciation was like 1% over like 3 or 4 years. Then we've got the last 3 or 4 years where it's been like 60% over 3 or 4 years. So
Right.
I
Right.
just thought I wanted you to
Which is
mention that
because
because I
our
thought
market
that
has
was a
been
great
behind.
product for people to know about, because it might be an option worth looking into for a lot of people.
Yeah. Agreed.
All right, so I wanted to touch briefly on sort of the national trends, basically because sometimes our market is similar to national, but more often than not, it's not. We tend to beat to our own drum here in Northeast Tennessee when it comes to the housing market, but there are some similarities. So you can see nationally, new listings are up 15% on a month over month change. So that's from February to March, but inventory is still low. So even though more people are selling their homes, there's still a lot of inventory. So it does give you some more options if you're out there buying, but you can see home prices are still going up. And that's because there's still not enough homes to go around. Even though inventory is up, it's still not up enough. So that's keeping that upward pressure on home prices. Time on market is actually down from the previous month. It's at 8 days. So since supply is too low for the number of buyers out there, houses are selling fast, and there are still ones out there getting multiple offers. So there are definitely more buyers than there are homes available. So each home that comes on the market becomes more of a hot commodity than it might if there were more options to choose from. That's that quote right there from Bankrate. So what does all this mean for buyers? It means you actually do have some more options that are out there for you to look at, but you're still going to want to move fast and come in with a strong offer. If you're thinking about selling your house should still stand out and may get multiple offers if you price it right. And there's two key words there, in my opinion. One is it needs to stand out. So it's no longer just listing it while it's still dirty and got dog hair and stuff everywhere. It's about making your house stand out from the crowd and pricing it right. Those are the ones that are getting the most interest. There's plenty of overpriced homes just sitting on the market right now. So this is a quote from Lawrence Yun. He's the chief economist for the National Association of Realtors. He said, housing demand has been on a steady rise due to population and job growth, though the actual timing of purchases are going to be determined by prevailing mortgage rates and wider inventory choices. So what he's saying there is the ability of, while the housing need is continuing to grow. The ability of people to purchase housing is is highly based on where the mortgage rates are at, because that affects how much they can purchase and what they qualify for. But then also the inventory levels. It's hard to purchase. It's not hard. It's not impossible, but it's definitely a little competitive out there when there's 5 or 6 buyers for every home that there is on the market for sale. So that's what he's saying. That's kind of the limiting factors on the current market, and you're going to see a lot of those limiting ones here as well. And just to kind of give you an idea, Josh, what have you seen as far as pre-quals and activity on the mortgage side so far this year in our area?
So, January and February were really slow, which is normal. Um, Typically, you see
Hmm.
an uptick in February, people getting ready for March. Um, January, everybody's recovering from the previous year plus the holidays. Um, so it's kind of a quiet time in January. But February, typically things pick up. But February was slow as well. And March really was more like February normally is. So I think we're a little bit I think we're a month behind this year than normal. Usually March is a killer month. February with a lot of prequals, March with a lot of pending contracts and people buying and
Yeah.
selling. I think that was more or less April this year. But I'm seeing things pick up as far as applications and people applying, and how it is. There's a lot of scare when things kind of went up and people waiting for things to change,
Hmm.
and it didn't really change much. So, if you're
Yeah.
like me, it's kind of like, well, I guess it's just time anyways. We'll just roll with it because, it's not like you can just wait a month. You have to end up waiting 6, 8, 12 months before
Yes.
the thing that you're waiting on to change. And that's a long period of time. So,
Yeah. So taking a look at the local real estate market, so if we look at the pace of new listings coming on the market, you can see it's not varying much from previous years. And that's one of the things that you'll see later that is kind of a problem with adding inventory to get homes on the market and to meet the demand is that pace. I took out the other years, but I had every year all the way back to 2019, and that those lines looked almost on top of each other. So the we're not adding more homes to the market at any higher of a pace than we've done in at least the last decade. So it's not like builders are getting out there and building. It feels like they're building tons of homes, but when you look at the actual rate of homes hitting the market, they're not doing anything different than they've done in the most recent past. So what that's doing is it's having a little bit of effect. So this is the total listing count. This is sort of a new graphic, not a new graphic, but a new statistic, not a new statistic, but a new statistic I'm showing you all. It's basically adds together the number of new listings, the number of pending listing, or the sum of the active listings for sale, the sum of homes currently under contract, and the sum of those sold in a month. So it's giving you a big overall picture of total inventory that's in a market by counting not just what's for sale, but what's also under contract and has already sold. So you can see we're doing slightly better than last year, but we're still well below 2019 and earlier than that. So that's why you can see our active listing counts is about the same. We're better than last year, but still nowhere near either what a balanced market would be or years prior to the pandemic.
one thing I like about the graphs, Jay, is that they always show the same trends. They may just be off in overall volume,
Yes,
right? So if you look at the graphs, you'll
yes,
see the same trends. They may be off just a little bit, but you can see the same ups and downs throughout the course of the year for each graph. It just may be different as far as volume. So, which we know 2019 and
absolutely.
prior was a pretty normal market. Basically we had 2008,
Hmm.
and then we had something else in 2012 that happened in the economy, but it wasn't as bad as 2008. But regardless from that, the market was pretty
Hmm.
normal. You'd see the normal numbers and normal ticks, right? But we've not been back to that level
Yep.
since COVID, since, the rates coming all the way down and people being in a frenzy of purchasing and selling, right? So, but the graphs still all show the
Yes,
same trends, is what I like to see.
they do. Now, the only ones that don't are 2020 and 2021. And part of 2022 kind of
Yeah,
bounced in and out of the normal trends. 2020 and 2021 did not
right.
follow any normal trends. But since then, we have seen it return back to normal, which helps make things a little bit more predictable for those. And as far as how we advise our clients, it's no longer just I
Yeah,
don't know what's
yeah.
going to happen. There's a little bit more predictability to it, but it's still. I mean, if we look at active listings, the one um, trend line went away. To get back to what we would call a balanced market where the supply and demand are somewhat balanced is closer to that 4,000 listing mark. So you can see that we're
Right,
nowhere
right.
near 4,000 listings on the market. So and because of that, that's why you're seeing things like the average sales price
Yeah.
continue to climb. It's climbing at a more moderate pace than it has in the previous years, but it's still climbing. And you can see even the sales; those trends are not far
Hmm.
off from what we call normal trend years. So we're not really adding any huge numbers of new listings to the market. Um, but what that does, you'll see in a couple other slides, especially if you follow them on the weekly one. Anytime we get more listings added to the market, it results in more
Hmm.
homes going under contract. So it's not really making
Right,
a dent in the inventory. It's
right.
getting absorbed by the buyers that are out there currently looking. And then if you look at monthly home price appreciation, you can see January, February, and March were all higher than last year. March, the median price, the average price was up 6.6%, and the median price was up 6.2% from March of last year. So you can see the trend line on prices is still fairly
Hmm.
healthy, moving up. And so this is looking at single family homes, and I just picked you can you can argue down in the comments about why I didn't pick Piney Flats or do other ones, but I just kind of tried to keep it simple just to sort of illustrate the point. You can see like in Bristol, in Irwin, in Kingsport, where there was inventory, sales activity was happening. So like in Bristol, there were 14% more homes for sale on the market in the first quarter, which resulted in 4% higher
Hmm.
contracts and 10% higher median price. Same with Kingsport, 14% higher list, higher homes for sale resulted in 20% more sold and 26% more under contract. Irwin had 39% more listings for sale on the market, which resulted in 65% more homes under contract. Whereas you look at Johnston and Elizabethton, they're actually their inventory levels are down, which has resulted in their sales and contracts being down, but not their prices, because low inventory still moves prices up. So, and you can see the bottom is the
Hmm.
entire MLS. We had 9.2% more homes on the market during the first quarter of this year compared to last year. And we sold almost 3% more. We have almost 10% more currently under contract to close. And then, 6.1% median price increase. So, sort of my final thoughts is persistent low inventory levels continue despite starting the year with gains. So even though we've got a few more homes on the market for sale, it's still not making up the difference, which is resulting in continued upward pressure on home prices. And so as new listings enter the market, that's sort of the throttle for sales. So if we don't start getting more homes on the market for sale, sales are going to start lagging again. And as always, if there happens to be, for some unknown reason, a big drop in mortgage rates this year, that's going to bring a buyer frenzy back to the market, which is going to push prices up even faster. So you can make you out there can make your own judgment on what you want to see. But I can tell you this: if mortgage rates go down, you're not going to see home prices go down.
Agreed.
Yeah, um, and I think everybody tried to say mortgage rates weren't going to be that volatile this year. I think that was wishful thinking.
Agreed.
Yeah. As you can see from what we've just talked about, kind of that first quarter was an interesting quarter, and this market continues to be interesting. We do see some patterns that are kind of mimicking normal patterns, but um, all the predictions of lower mortgage rates and certain things going on in the housing market, I think, have already proven that nobody knows what's gonna happen this year when it comes to those things. So it's really just wait and see. It's really talk to professionals like Josh and I that can walk you through what your current options are, and we won't try to bring out a crystal ball and predict the future for you.
Agreed.
So what are your closing thoughts, Josh?
We're here to help in any way we can. If you've been looking to purchase, we'll say it over and over again. Now is the perfect time to buy. If you're waiting for the rates to come down, as you can see, the volatility is still there, so we don't know when it's going to happen.
Mm-hmm.
I will say I don't foresee rates going much higher like we've seen around 7.5 and stuff in the past last year and stuff. It could happen, but I don't see us ramping up over that. I see us dabbling once again in the sevens like we have been, balancing out and going back down in the high sixes. I think we're going to be playing this game of a roller coaster where it's up and down around the same area throughout the year, and hopefully jobs continue to increase, job reports turn out good, inflation starts to come down, all the things that we needed to. But me and Jay's not in control of that, or myself and Jay not in control of that, but we're here to help you throughout the process to get you into a home. So
the only thing that I can almost guarantee, I won't go fully into 100% guarantee, but it's highly likely that home prices are going to continue to climb.
agreed.
So waiting is only going to cost you more
Yep.
for that house that you want. So the people that try to time the stock market, say buy low, sell high. Well, right today is as low as home prices are going to be for a while.
Yep.
So probably for forever, but nobody knows that fully. But
Yep.
at least for the next year to a few years, they're with this low inventory, they're just going to keep climbing. So if you've been waiting to buy, thinking about buying sooner rather than later would probably be in your best interests, because if rates go down, you can always refinance and lower that payment.
100%.
All right. Well, we're going to end there. Hopefully we didn't get too long-winded for you all. We did want to cover some things, but then we really tried to move through some of the other stuff. We appreciate those of you that did tune in. As always, if you're looking for a loan or just mortgage advice, reach out to Josh with Movement Mortgage. If you're wanting to start looking at homes, or you're thinking that you want to sell your home to move up, move down, or maybe you've got a job transfer, you're moving out of the area, whatever the reason is, I would love to sit down and talk with you. If you're looking to buy a home, talk to Josh first. Then we'll sit down and start putting a list together of what we need to go look at for you. So that is it for this month. I'll see you next month, and Josh and I will see you in a few months.
And hopefully rates by then have come down a little bit.
We can all hope.
That's right.
For sure.
But thank you guys for your
Thanks,
time
everyone.
today.
Hope you enjoyed it. Have a great week.